Over the last 4 years, I have been trying to know all what is out there about the markets. But in this video, I'm gonna share with you the few that stick to me, saving you the time and money in order to go and test it out yourself. And I'm going to give you the rules and time to look for those setups, which I use every single day in my trading. We're gonna be explaining low resistance liquidity runs versus high resistance liquidity run. But before we do anything, I want to say one thing, which is having a bias and framework comes first. I will never pull the trigger on a trade solely because there is a low resistance liquidity run. Just keep that in mind. You need a higher time frame perspective and bias. Now let's get into what is a low resistance liquidity run and how it could help us in our trading. So it is also known as a failure swing. It's when a swing low fails to take out a previous swing low, or when a swing high fails to take out a previous swing high. Low resistance liquidity run could be used to frame a trade around it. So in this example right here, we have higher highs being formed right here until we reach a higher time frame PDRA, which could be anything from a fair value gap, order block, breaker block, rejection block, anything, but it has to be from 1 hour and higher. When we reach it, we're gonna see this change of character, like right here, and we fail to displace above this high. Now we can start looking for shorts, and this is our buy side, this is our short side of the market. We will talk about that a little bit later in the video. The same thing on the opposite side. We are making lower lows, but those are holding. We are not. A high resistance liquidity run would be something like that, and we're gonna see on the next example, we have liquidity below it right here, and this is the beginning, which is our target. We'll meet our high time frame PDRA, we change character, and we go towards our target. This is for the low resistance liquidity run. We're gonna have some rules around it, and we're gonna see it in the market to have more clear idea. So a high resistance liquidity run is when a swing high sweeps a previous swing low, and inversely, when a swing low sweeps a previous swing low, before continuing in its respective order flow until an opposing higher time frame PDRA has been met. Let me show you what that means. This right here is our low resistance liquidity run. This right here is our high resistance liquidity run. As you can see, we are taking the liquidity from the previous high and going towards our target, which is the low of the low resistance liquidity run. This is what is called the high resistance. This is what's called the low resistance right here. We always want to see the high resistance liquidity run on the side of the curve that we are trading, and we want to see the low resistance on the opposite side. This is an opposite example when we are going higher. This is the first example we had. So all those right here are low resistance liquidity run, and we have liquidity below them, above them. And this is what the market is doing. We are going and targeting those liquidity while having a high resistance liquidity run, which is most probably we're not gonna retrace back. But when we see a move like that, we will understand that there's something wrong, and we might go back to target those areas. Now, some rules to follow. Number 1, never trade against a high resistance liquidity run. Number 2, target low resistance liquidity run as there is liquidity resting above. Number 3, stop loss at break even once all the low resistance liquidity run has been taken. Also, I want to share some things from my notes. If you want, you can copy it, or I can put a link for this page so you can duplicate it on your Notion. What is the difference between low resistance liquidity run and high resistance liquidity run? So low resistance, we want to see them on the opposing side of our structure, which means targeting it. It's basically bearish failure swing. We want to see that when we are bullish failure swing. We want to see that when we are bearish. The market will usually go through opposing failure swing with ease. We will just cross it really easy. High resistance liquidity trade, we want to see these forms on the side of our structure, which means the side that we are trading. It's a low that ran a previous low and rejected is a high resistance low. A high that ran a previous high and rejected is a high resistance high. We use this logic on all time. We will see some examples right now so you can get a better idea of what I mean by all this. Okay, so we have this example right here on EURUSD. I actually picked this example because I wanted to be as clear as possible. As you can see, this side is the sell side of the curve. Okay, over here we reach a higher time frame PDRA. In this case, as you can see, it's an order block. Okay, when we reach this area, we are expecting some sort of smart money reverse, which is exactly what we were talking about. We can see that this made a high resistance liquidity run below this low, and then we went higher above this high. So now, if you are trading, for example, New York, I want you to put a vertical line at 8 and check where is the liquidity being held. Where is our low resistance, where is our high resistance liquidity run? This is our sell side of the curve, and we can see this is a low resistance liquidity run. Right here is low resistance, okay, as well as right here is low resistance. So this is our 8 opening. We didn't take this low resistance yet. We took this one and we have this one resting right here. What we want to see is high resistance on our side of the curve. And over here we have those two right here, which got purged by this candle and went higher. Now we understand that we hit a higher time frame PDRA and we are on the buy side of the market, making high resistance liquidity runs and going toward our target right here, which is this order block, and definitely targeting all these low resistance liquidity runs right here, which give us a direction of where we are going with the market. Now, understanding this, we can look for any PDRA, because most of them will hold when you understand where are you in the market, what is the bias, and where are we heading. Almost all PDRAs shall hold. So this is a trade right here targeting the order block and all the low resistance liquidity run right here. So for example, we can just target this low resistance liquidity run right here, and we can actually put our trade if we go to the lower time frame somewhere below the order block, and it could be better if we go to lower time frame, but this is just an example. I want to show you more so you can have a better idea. If you are enjoying the content so far, I would appreciate it if you could subscribe and like the video. It means a lot to me. And if you want me to make a video about the market maker model, please let me know in the comments, because everything I'm mentioning here is part of the market maker model, but I cannot give it all at once. It's better to give it in small portions so you can have a better idea. Right here, what do we have? Let's say, for example, this is our opening market, open at 8. So at 8 we look to the left and we see where is our low resistance. As we can see, we have this right here, we have this right here, we also have this right here, while on the other side we don't have any liquidity to be ran below. This is here, probably we have a higher time frame PDRA. If we go to the daily, this is the order block right here, which we held, and if we go lower, we came right here, we took this liquidity down below and we shifted higher, just as I showed you in the beginning of the video. Once we understand that we are now going to the buy side of the curve, and then we see this purge right here, which is the biggest sign after we already changed character, then we understand that any PDRA going higher shall hold. So in this case, before 8 we look to our left and we can see that the price is most probably going higher. This is another example. We can also look here, this is 8 vertical line. We can look to our left and we can see that this is a low resistance liquidity right here, which could be targeted. So after the open, we can see that this right here was taken we went below, we hit the fair value gap, and we target this low resistance liquidity right here. This is all part of the market maker model. So again, if you want me to make a video about that, please let me know. But guys, all this without actually understanding what is really happening, understanding your psychology, where are you struggling. You could know all the technicals, but your psychology could still make you lose money instead of making money. And journaling is a great way to understand those problems and work on them. That is why I would recommend that you watch this video right here. It shows you all my journals and all the techniques and the template that I use in order to journal my trades, which helped me become a profitable trader. I hope you enjoyed the video. If you did, please like and subscribe again, and see you on the next one.